Okay, tactical money advice, things you can do right now to fix your situation, to improve your situation, even if you're good with money and have a lot of money. Now everyone's got their own way of doing things, right? But the things that I've learned over the years, as far as like investing in programs, investing with people, buying stuff online, yada, yada, yada. There's so many things that we do on a daily basis that involve money that, and then I've noticed that like a lot of people don't know some of these basic ways to protect yourself, to operate, that gives you an upper hand, and just some really tactical points on money. So the first thing they have to talk about is credit. You have to protect your credit. So there's a lot of people, you might have messed up credit. You might have messed up your credit. If that's the case, I suggest you go crawling back to your creditors and negotiate. A lot of you have credit cards that you haven't paid or something like that. The last thing that you want is for your, unpaid credit cards to become charge-offs and to go mess with your credit, right? So a lot of times if you owe money and you can't pay it, you can negotiate it. You can call them up, come up with a payment plan, something to put your credit line back into good standing. This is really important because if you don't have good credit, if you don't have good credit lines, don't know how to use your credit to your advantage. And this is where we're going to talk about debit cards, right? So for some reason, poor people seem to think that debit cards are like a safe way to bank. And I recommend if you have a bank account, a checking account, do not have a debit card. Just don't have it. Call them up, have them eliminate it off your account, delete it from your account, and shred it. And any public transaction that you make, right? Like anytime you go to a grocery store, you go to a restaurant, you pay a bill, you should use your credit card. You need to use your credit card. Why? Because when you use credit, first of all, a credit card has multiple layers of protection. So if there's an issue with something that you buy, or if there's a discrepancy with the product or the service, you can just call your credit card company and dispute the charge. Be like, hey, they didn't deliver the service, they didn't do this right, they mess it up, here it is, no problem, file the dispute, boom, you're no longer liable. On some credit cards, like the Amex, they have purchase protection, which is even better than disputes. In other words, you buy a product or service, decides you don't like it, purchase protection, there's an issue returning it or something like that, you can implement these strategies. Now, the problem with the debit card, okay, and there was a case with a Starbucks, okay, which is probably one of a million cases, right? Where there was a girl working in the Starbucks. Anytime somebody would put their card through the window, she would take it, snap a picture of it on her iPhone, and then swipe it on the transaction, give the card back, right? What happened? She ended up with a database of credit cards from people who used their credit card at the drive-thru, sold it on the black market, or worked with some scammers or something like that. Eventually she got busted, right? But now you can imagine that girl versus how many times that's happening in however many other places stuff like that goes on. You got credit card skimmers at the gas station. You've got RFID readers that can basically just, I can just like walk past you with it and just get your credit card number. So now credit cards have the best purchase protection, right? So credit cards have the best protection against fraud because you can always dispute it. If you didn't make the charge, you are not liable for the charge. This is very common in the credit card industry. But what's the problem with a debit card? The debit card links directly to your cash account. So you make a purchase with your debit card number gets stolen, and somebody, pulls $3,000 out of your account, if you even have that much cash sitting in the account, right? Or they max out. They're going to figure out what's the most amount of money they can pull out. They try one fraudulent transaction at $3,000, declines. Okay, that means there's not enough money. They get $2,500 out. Boom, you're left with like 93 cents in the account. What can you do to get your money back? Now, it would probably take you 3 weeks to a month to actually get a proper dispute process through with the bank. This becomes one of those situations where, you're left without the cash. It's all because you used your debit card somewhere stupid that you shouldn't have used for a transaction where the number got stolen, right? And this happens all the time. So the first thing quit using your debit card. This is like the dumbest way that you can transact is using a debit card. You're constantly at risk. Your cash is constantly at risk. It makes absolutely no sense. The way the average person operates is typically they have a checking account and a savings account. And if they're lucky, they have some sort of a retirement account, right? And people think that the money goes into checking accounts. We put a little bit away into savings. And this is the operating basis, a checking account and a savings account. Well, here's a little anecdote. Okay, so I've been on a project at work in another city, and I have to get I've been using Airbnbs, but I figured, I looked around and found a place where I could get a lease, right? And so the lady's asking me all the standard, property management questions, not even realizing the fact that I do property management myself. Like my partner manages 400 units. That's how I've learned property management. I manage my own properties. So I know the game, right? And, she made a comment because she asked me, asked you for bank statements, things like that. And I said, okay, well, what account do you want a bank statement on, right? Just the same one you pay rent. Okay, fine. So I give her that account. It's my operating account, my personal operating account, where I don't keep cash, okay? I don't keep cash in my personal operating account. Why? Because first of all, if you just pile up cash in a personal account under your name, it's the first thing that's going if there's a lawsuit, a dispute, a lost debit card, right? That cash is not safe in your bank account, necessarily speaking, okay? Now, it is safe in it's insured by the FDIC. If there's some sort of bank run or something that occurs, eventually you'll get your money back. But, like in the case of this bank, the First Republic Bank or First California Bank or whatever, during COVID, a bunch of these independent banks went out of business. They basically just collapsed and nobody could get their money out. Then the Fed comes through and reissues the currency and says, here you go, here's your money. It's insured. That's why it's insured. So these are things that the average person's not thinking about when it comes to money, right? So how do you manage your money with all these factors going on, right? And so that's why I say the first thing is nurture your credit, have credit lines, okay? Now, I'm not saying use your credit lines to buy things you can't afford. Don't spend money on your credit lines unless you have the cash. But, generally speaking, the majority of your purchases, whenever possible, should go through your credit cards, right? Now, there's another layer to this because if you have really good credit, you have good credit cards, every time you spend money, you're getting points back, you're getting paid, you're getting cash back up to 5%, right? So, there's absolutely no reason to be using a debit card for transactions. Now, you have purchase protection from your credit cards, right? So protect your credit lines. Look at your credit lines as your investors. Now, a lot of people will say credit cards bad, the Dave Ramsey mentality, right? It's like debt is evil, it's the devil, cut up your credit cards. Yeah, if you have consumer debt on a high APR credit card, of course, it's going to be impossible to get out of debt because this is the trap. See, the poverty economy, there is something which I call the poverty economy. And the poverty economy profits from people's ignorance and lack of financial literacy. So, people who aren't paying attention to their credit card rate, they're not paying attention to their promotional balances, they're not paying attention to how they're paying their cards down. They're not paying their cards down. They're just paying the minimum payment, getting away with the minimum, right? Then they end up paying interest every time they rack up that balance, interest. And that's part of the poverty economy. If you're using credit cards like poor people, you're going to get raked over the coals because that's just the way the banking system works, right? That's their way of holding you accountable to make sure that you either pay your balances, or if you are just paying the minimum payment and racking up your limits, then they're going to rake you over the coals with interest because that's how they make their profit, right? And they know that eventually you're going to stop paying, right? The poor people eventually stop paying their credit cards and it goes into collections, and then they have to sue them, and then they have to get, restitution. But they know at least that, hey, this person's paid interest at least for the last 2 years and probably paid more than they owe in interest when they could have just paid off the card. So this is part of the poverty economy, right? So now the wealth economy, where I've seen people that own businesses that have, $100,000 in debt on their credit card, but they are constantly paying it down, and they're constantly earning points, and they're constantly, tracking their promotional balances. So they're not paying interest on that debt. They have higher credit lines. These are the things that you have to think about. These are the things that most people are not thinking about when it comes to your day-to-day use of money, right? So now, if you're an investor, or if you are somebody who is on the winning side of the equation, aka you're an investor, you're a business owner, you own assets, right? Then typically, the assets have their own bank accounts, right? Everything has its own bank account. The accounting determines, depending on what type of business is, the accounting determines whether or not it's a pass-through vehicle as far as a taxable entity, or it's taxed separately and that sort of things. But the point is that the average person is just operating off of a checking account, using a debit card. The credit's fucked up, and they're not properly operating things, right? Whereas I run very lean on cash on my personal account because I'm using credit for everything, right? And I'm constantly building and improving, maintaining my credit. Now, I have business accounts that maintain a certain threshold of cash, right? But what happens if cash goes into this specific account? If I have an overage of cash in my personal checking, it's going to get moved out to a different account. Primarily, it's going to be invested into my business account because it's completely untouchable, right? So these are the things that you have to think about, right? These are the things that you want to think about when it comes to money and wealth and managing your money. There's a key aspect of all of this that goes into budgeting and managing your money, and that's all great. But part of that process is understanding what are your wealth vehicles? What are the vehicles that you're using to transact? What is the cost of that capital? What's the cost of the debt? And what is the risk? Because if you're an investor, everything is ultimately about the risk, right? Understanding the risk. What's the risk of having cash in the account versus paying down your credit cards and having that revolving credit line available? Now, here's I'll give you guys an analogy here. If you look into this thing called velocity banking is really cool. It happens to deal with amortized debt, aka mortgages, right? So mortgages are amortized over 30 years. The principal and the interest is split. So it's very different from a credit card that is simple interest. Basically, when you take out a mortgage on a house, your interest is front loaded. And after, it's a bell curve, right? After 5 years, 10 years, 15 years, eventually that interest starts to go down and your principal payments start to go up. So what happens is that if you were to take a $10,000 chunk payment off the front of that mortgage in the first year, you're most likely not going to be making very much of anything in payments towards principal. So when you put a nice chunk of payment on it, that's going to equate to like $50,000 or $60,000 in interest payments. So that $10,000 becomes worth $60,000 over the life of the loan for that amortized debt. And, people think that a credit card, which has typically if you're not on a promo balance, you're paying 20 to 30% interest, which is totally asinine. It's totally insane. But at the same time, if you're using that credit card and you're paying down the balance so it doesn't accrue interest, then there's no consequence. You're not paying finance charges. You're not paying interest. You only pay interest when you start carrying balances. So the way that this velocity banking thing works is that, you can basically front load, you can take that debt that has all this front loaded interest. You got a credit line. You can do a balance transfer off that debt onto your simple interest credit line. And you're saving, if you calculate the interest, it's like astronomical compared to even if you have a 20% on the credit card, right? So because that 20% is charged over the course of a year, it's not 20% every month, it's 20% a year, which equates to, 1.7, 1.8 something percent per month. If you can pay it down in 3 months, you're only going to end up paying, 4 or 5% interest on that money, whereas it just bought off like tens of thousands of dollars in interest on your mortgage. So using that concept, if you look at your day-to-day personal banking, right, you have credit lines. So you have, $50,000 to $100,000 in credit lines, which you should have. if you're earning at least six figures, you should have this in a credit line, because that means you always have capital available. Now, I'm not saying you're just going out and racking up the debt, but you have the spending power. And when you have the spending power on your credit lines, now, Dave Ramsey again is going to tell you, pay off all your balances, cut up your credit cards, don't use your credit cards, get out of debt. Now, yeah, if you have consumer debt, bad consumer debt, and you're paying on the interest, yes, you should definitely get out of debt. But if you are operating businesses, if you have a lot of expenses, you should use your credit cards, earn your points, manage your interest, and use that to transact. Don't put your capital at risk. Don't use your debit card, put your bank account at risk, right? This is what I'm trying to tell you. So anyways, going back to this real estate leasing agent, right, she's like, well, the balance on your account's low. I'm like, yeah, it's because you can look at the account statement, see where the money went, right? You can see that there was money in the account. You can see X amount of things were paid, rent was paid, this was paid, right? This amount was transferred. Yeah. So it was just funny to me. But I get it, because the average person that's renting is not going to, typically they're not going to be good with money. They don't have any sort of process or system that they're following at all, and they don't have reserves. And so I just thought it was funny that she was judging me based on that. Then I sent her a whole bunch of other stuff. And, of course, and she's like, yes, we'd love to move forward with your application. But it was funny. It just shows you people have no idea how to manage the money that they have. And so, because all your free cash, it needs to go into a savings account, it needs to go in a financial freedom account, which is where you store up money for buying assets, for investing, even a savings account, right? Like if it's a high yield savings account, maybe it makes sense to store your cash in there, but you should be buying assets, you should be investing. And if you're going towards financial freedom, that's what you're doing with the capital. You don't just sit on the capital. You don't just throw it in a savings account. Sure, you should have some cash in there, or you should have an operating account, or you should have cash in very intentional accounts. But my point in saying this is that a lot of people just use their debit card. This is why people struggle. They're not putting away money for themselves. They're not saving money for themselves. And this is the thing that you should be doing. And then you should be investing in your credit lines. You should be building your credit. You should be paying off all your credit lines. You should take every dollar you have and pay off all of your interest-bearing commercial debt, whether it's a credit card or otherwise, and stop paying finance charges and interest. And don't worry about having cash in the bank as long as you have spending power in whether it's your credit, you have other operating accounts. And so, because look, at the end of the day, what actually matters is it's your net worth. You know how to calculate your net worth. It's based on how many assets you own. It's based on your cash flow. And then, of course, you should not be spending more than you're bringing in, right? You should have some net positive cash flow every single month and know where to allocate that. And it's never a bad thing to allocate your free capital towards freeing up your credit lines, because guess what? Once you put that capital, that cash from your bank account onto a credit line, all of a sudden that credit line becomes spendable. So that cash just moves from the bank to a credit line. Again, that's the way the system operates. The system operates on debt. Money is debt. I've talked about this. So yeah, don't get it twisted. Getting caught in high interest loans or anything in the poverty economy will drag you through the mud, will rake you over the coals, and it will bankrupt you, right? So be very aware of your interest rates, be very aware of where you're throwing your money away. And then at the same time, protect the capital that you have, protect your bank accounts. So to me, this is common sense. But again, I've learned this stuff and, been through the ringer as far as like business transactions, disputes, things like that. So know how to stay in control and know how to stay in charge of your money.